Hello, investors. It's Don Vandenbord. Today is, as you know, Wednesday, 11/20, and this is the beginning of the 8th Revere Lunch and Learn. Today's topic is going to be gaps and inflection points. And if you could, let's see, if you could type in the question box that you could hear me, I'd appreciate it. Audio and video are good. Glad to hear it. All right. We are recording, so let's get going. Reminder, of course, right off the top, this is for educational purposes only. The concepts that we discuss here are what we use in-house at Revere Asset as part of our portfolio management approach, and we're not advising that you buy or sell anything. Please do your own due diligence and make your own decisions. We are providing this to the stock nerd and client and market lover community. We're passionate about education here at Revere, and this is the latest in the series. We've got our own YouTube channel up now where all of these are being posted to. All of these are also out on our webpage under webinars, where you can sign up, and under Daily Market Insight, if you scroll back, they're archived. But YouTube now is probably the best way to get a hold of everybody. Let's start out with trend of the market. We continue from the trend gauge to be in an uptrend, as you can see, and that means that all 5 of the major indexes that I talk about in each video are trending above their short-term 21-day exponential moving average, medium-term 50-day simple moving average, and long-term 200-day simple moving average. Secondary indicators, let's get to them very quickly. Fear and greed index got up to like 93 last week, which is excessive. If this starts ticking back, that is a sign that we're going away from greed, but reminder, this can go all the way back to extreme fear, and somewhere in here is the possibility that we would be taking off some exposure, especially when we look at if price and volume cooperate with what we're looking at. And the put call, which you can see is started out very elevated today, ticked down. It's in the 9s and 8s as long as you see it there and not in the 6s, which means there's extreme complacency that tends to put in a short-term top. McClellan summation index, notice that this has ticked over a little bit. If it gets below 70 and starts trending down, it's also a signal that a pullback could be imminent. And finally, the VIX, still trending from lower left to upper right. If this becomes inverted with either the green dashed line rising above the near month contract or the December contract getting above January and above February, that's also a signal that a pullback is taking place and there's more risk coming into the market. Let's take a look at the major indexes now. You can see the S&P 500 basically going sideways very nicely. We can correct through price or through time after this nice 30-day run-up that we've had above the 8 EMA, 10 EMA, also the 21 EMA. Very nice if we could go sideways. Leaders continue to act very well and have the 21-day catch up to it and a bounce off there. That would be the reversion to the mean that Tim's been talking about lately. We're definitely looking at that, but for right now, the market continues to be very strong. QQQ NASDAQ 100, very similar, riding up. The 8 EMA, the 8 EMA and the 10 EMA are very close to each other. The 8 EMA weights the newer days more heavily than it does days -7, -8, and the 10 simple, which a lot of people use also, they end up being just about the same. NASDAQ 100, you can see here, looking very similar to the S&P 500. Let's go to the Dow Jones Industrial Average now. 28,000 acting as a little bit of round number resistance here, pullback. We're sitting on the 8 EMA here. How about mid caps, the MDY? Not a lot of people talk about mid caps. I'd love to look at the mid cap index. Think about this as the incubator for the next big growth stocks that are going to graduate into the S&P 500. So that's why I think it's critical to pay attention to that. Giving up a little bit of relative strength, going sideways, consolidating nicely above the 21 EMA, as is IWM. I added a position in TNA, small position today, to the Grotection portfolio, as this is doing a nice job of correcting sideways. Look at this relative strength that we saw for about 3 weeks here. Now a little bit of sideways action ticked up over the last couple of days. I like how this is consolidating here. If this could bust above out of this base, you can see the green lines here for this nice 138 days long, 10% depth. This is about as nice a consolidation as you'll see if we could get up out of here above 160, 161. I think the market's got another leg up. Whether or not we come down and touch the 21 before that happens is absolutely up to the market. So that's the major indexes. Now, education. We're going to talk about gaps and inflection points. Now, many years ago, I would have considered a gap up to be bullish and a gap down to be bearish, and that was it. But I've come over the years to realize that there are a lot of nuances to gaps. And I've kind of put them into 5 different categories, and each of those 5 categories can have one of 3 different outcomes. So anytime there is a gap or an inflection point, it can resolve up to 15 ways between the 5 different types. So the first type we're going to talk about, and the most bullish, provided it resolves to the upside, is the extreme gap up. And basically this is a gap up on huge volume out of a base, usually to all-time highs, and it usually happens with a news event. Very commonly, it happens with earnings being reported, or maybe a drug approval if you're a pharma company, or a big upgrade, or a change in regulations, some type of thing to just signal that Wall Street is off sides, and portfolio managers and hedge fund managers find themselves tripping all over the place to get into the stock. The flip side of that is the extreme gap down. This also happens on just the inverse of negative news normally. But an extreme gap down can very often be an entry point. It's not necessarily bearish if it puts in a bottom, and we'll take a look at that when we go through some of the chart examples. The cousin to the extreme gap up and down are just more a mild gap up or down, and think about this as a situation where a stock's maybe starting to form the right side of the base. It gets some news and it gaps up, but it doesn't gap out of the base. But it does indicate an inflection point. You'll see a very obvious gap. You'll see space between the prior price and the current price. And then the flip side of that is a gap down, which is not a complete breakdown, but maybe still in the consolidation. But again, it means a change in character or an inflection point. And then finally, this is really not a gap at all, but it falls into the category of a reaction or an inflection point. And this is just a range expansion that happens. Suppose earnings are reported and algorithms love to kick in. They'll go to you'll see a range expansion. That means that the high and the low for the day that this event happens kind of jumps out on the chart as a very long candle. As algorithms hunt for stops both on the upside and on the downside, settle somewhere in the middle, and then we're going to look for clues in the next coming days to see if it's actually an inflection point with the individual stock that we're talking about. So as I mentioned, each of these 5 types can have a resolution either bullish to the upside, bearish to the downside, or neutral, meaning really nothing happened. We stayed in the trading range established by the gap or the range expansion, and you just move on to something that's acting better. Really nothing to do here. Very key. I got a lot of questions about gaps being filled, talk about into this. So you can't only look at what's going on with the gap. You have to look at what's going on, first of all, in the overall market. If the market is in a downtrend, most likely you're going to see gaps up be sold. and the gap up will put in the top. When the market's bearish, there's just not people looking to get heavy long. On the flip side, if you'll take a look at gaps over the last couple of weeks, as the market has gathered some strength, gaps up have resolved to the upside. So a positive market, a negative market, and this also can trickle down to whether or not the sector itself is in favor. This is going to impact some of the how the stock acts after the gap occurs. Also impacts while you're still in the range is moving averages. If something is going to pull back or if something is going to try to go higher, are there moving averages both to the upside and the downside that would act as resistance or support? And then not necessarily moving averages, but looking to the left side of the chart, are we going to see resistance and support of price action? For example, if there was a gap up here, let's take a look at the chart over here. This was kind of like a gap up here on 11.1, and we just ran into, we've got resistance here, we've got resistance here on the left side of the chart. So for now, this is keeping this from going any further. On the other hand, to the downside, we've got a moving average, which is the 21-day exponential moving average, acting as support for it. So a lot of things to consider when you are trying to determine how the gap or the range expansion is going to resolve, to the upside, to the downside, or is it just going to stay neutral? So I've got a bunch of examples here, and we're going to get to them. In fact, it's very nice to see sometimes as I was searching for examples that within the chart of an individual stock, very often you'll see multiple examples of the 5 types as it goes from one earnings report to the next earnings report, and you can see the bullishness and the bearishness. And what I want you to pay attention to the entire time is this black line above the top of the chart. This is indicating what the market is doing at the time that the gap occurs. For example, right here you can see late April into May, pretty serious downtrend here. Another downtrend here from late July to the beginning of September, and now you can see the market heading to the upside as it's trending higher. So always want to take context into what's going on with the market and the sector, what type of support and resistance is the stock facing. And let's talk about the first type now, which are monster gaps up. And for these, I'm going to go back to 2013. I'm going to bring up Facebook. Facebook IPO'd. So we're looking at November of 2013 now. Facebook IPO'd and really didn't go anywhere, but they announced earnings on July of 25th, 2013, and the stock had a monster gap up. It was up 29.6% on 750% above average volume. This definitely gets my attention. It got my attention back in 2013. You dig a little bit further, you see that Facebook announced for the first time that they really seemed to figure out that people were starting to use their mobile phones, and we're really using Facebook for it, and their revenue increased from their advertising significantly. And you can see what happened in Facebook since then. This was really the moment when Facebook started to grow up and became a big stock. It had the gap up. So after you have the gap up, the things that you're going to look at are the top of the day of the range of the gap up, the bottom of the day of the range of the gap up. And you look and see what happens in the days subsequent to the gap occurring. So let's take a look at the market. First of all, you can see the market was in an uptrend when this happened, so the market's not a wind in your face. Then we're going to take a look at, I mentioned the volume was 750%, and it gapped out of this base. So far Facebook has everything going for it. So let's take a look at the next day. It was a very healthy inside day, and then day 3 it busted above the range of this gap up day, and this just flat out makes it a screaming buy. You could have bought it the first day. I'm not going to see the intraday show or be able to show the intraday chart of what happened that day, but the main point to take away here is that so many historical winners start with this big monster, this big extreme gap up, and you can't be afraid that you can't say to yourself, the stock just gapped up 26%. There's no possible way I can buy this. Guess what? Look at how Facebook went higher here over the next 2 months from 34 all the way up to 54. If you can capture a couple of these in a year, you can just really make your year. And then we know Facebook, what it's trading today, is at 198. So this was the beginning of the big run. I know some people that have held this all the way since 2013 through multiple bases that have formed. But you've gone from 35 to 200. So this is the type of thing that we're looking for. I'm also going to show another one that worked very much the same way. This was Tesla back in 2013. Tesla here announced a very surprising earnings reaction on May 9th, 2013. So the stock on the day was up 24% on 731% average volume. So of course, what's the market doing? Market, you can see it's in an uptrend here when the gap occurred. You've got the volume, you've got the surprise, you've got the extreme gap up. Now we look at the range of that day. So the top is 75.77, the low is 63.69, and we're going to see what happens if you didn't buy it that day, what's going to happen in the days after that. The next day it broke above the top of the range. This is known as a day 2 higher high, very bullish. So first day it was up 24%. You think, I can't buy that. It's up 24%. Next day it was up another 10.6%, and the volume was 542%. This is Wall Street being offsides. This is pension managers. This is hedge fund managers. This is portfolio managers. And yeah, the general public too, tripping all over themselves to get into this stock. And when you see the day 2 higher high, this is yelling, screaming out to you, you need to get into this stock. If you don't buy it at that point, the next low risk entry point I'm going to look for after that is a pullback to the ADMA, and that's the purple line on here. And if you didn't get into it there, you were able to get into it on this day here when you pulled back to the ADMA, or maybe these days here. Look at these 3 days here where volume dried up, barely getting back any of the gap up. And then it comes into the ADMA and it takes off, pulls back again. Now once you touch the ADMA, then you look for the 21 EMA for some signals on what to do. And don't think that this is going to be an easy ride. You can take a look at a day right here where it pulled back 14% in July. You've got to come up with a situation where you got to size it appropriately, and you got to use these moving averages to try to keep yourself in it to ride this for the long haul. And then of course you're going to get correction, so you got to have sell signals to take money off the table. So, but those are all totally different classes, which I'll address in some of the future lunch and learns. But the point here, the most bullish is the extreme high volume gap up out of a base to all-time highs, and then you monitor it for what's going on after the day of the high. So those are the 2 easiest ones to take off the table. You'll see the extreme gap down is just the opposite. You use the same rules. The mild gap up or down, same situation. You're using the high and the low of the gap up day. And as far as the low of the gap up day goes, on the mild gap up or gap down, you're also going to look at, as I mentioned, the market, but you're going to be looking at moving averages and support and resistance on the left side of the chart to see if it pulls back a little bit. Normally, you've got to give yourself 1 to 2% below the low of the gap up day to allow for some shakeout. The strongest ones, if the market and the sector are cooperating, stay in this range for a little while, and then you can, if you didn't buy it, you can look for a pullback to the 5 or the ADMA to make your entry, and then your stop is always going to be at worst 1 to 2% below the low of the day that the gap up occurs. So what I've got here is 27 different gaps, and we're just going to go through these and identify them as what type they actually are, and some rules around how to handle them. So let's start off with Vertex. Let's set back to today on the charts. and Vertex. This is something that I own currently in the Grotection portfolio, and it had what I'm going to term as a mild gap up on this day, 10/22, on an announcement that they got a drug approval for their cystic fibrosis drug, which has the potential to strongly increase their revenues over the next couple of years. So here's what happened on the gap up day here. Up 4%, 300% average volume. This is a nice technical and fundamental stock. So you can see it was still in this long-term base here. It's got good growth. Medical and biotech stocks acting pretty good. Market in an uptrend. So you've got all the things to consider in your favor so far. Now it's still in the base. So what are we going to do? We're going to use 1 to 2% below the low. It never touched it. The next day was an inside day. This is very healthy. The next day, you broke above the high of the gap up day. Now, we come into resistance here because it's the top of the base. So what's going to happen? Is it going to pull back? And it did pull back for 2 days on lower volume before it busted above it here on 10/29. So this is acting exactly how you want it to act. We've had one pullback to the 80 EMA, continuing to trend higher, hasn't touched the 21 EMA. I think I'm up about 11, 12% in this, just following the gap up rules for Vertex. This is a great example of how not an extreme, but a mild gap up can work in your favor. So let's just go to the top here, and I'm just going to scroll through these, and we're going to talk about example. So this would be considered a mild gap down. It looks pretty extreme, but it didn't break below a lower low. So Pinduoduo. This is a leading Chinese stock acting very well, reported earnings last night, and it gapped down. So the market is bullish. So what we want to consider here is if you were looking for an entry in this, if you know the story to this stock here, is this a sell or is this a buy signal? So we've got a mild gap down. It's not a death knell. It's not automatically mean that you got to dump the stock. So let's look at resistance. Resistance on the bottom has been right above $30, and if you look to the left, you've got a base formed right above $30. You've got a pivot point of 32 in the base prior to that. So you've got a lot of support here with the 30 area, the prior base, and the top of the base before that. It's very possible that PDD is just going to trend higher. I understand that the volume is monster. I understand that it's down 22%, but if you like the story and this puts in a bottom, you can make money in this. There are multiple ways to make money in stocks, and history has told me that a gap down. Now, if you owned it, that's a different story, and you've got to go to hopefully your position size, and I talked about this in the last webinar, that you've got to size it accordingly if you're going into earnings. So I would have sized this so that even a 20% gap down if I owned it, because, hey, it's coming out of a nice base, it's acting fine. If I owned it into earnings, this only would have impacted my overall bottom line in the entire portfolio by about 1%, and that's very manageable. So if I held this, I would be holding it unless it broke below the low of today's low. So this is an example of a mild gap down. You could argue it's an extreme gap down because it's 20%, so it falls somewhere into there. But again, now you're looking at the bottom of it to be the ultimate arbiter for whether you're going to get out, because it coincides to support on the left side of the chart. Let's move on to another one that gapped today, just the opposite. Now this is Target. So this is going to be an extreme gap up because it's at all-time highs. You've got 1,000% volume. It's up 12%. You've got the low of the gap up day. You've got the high of the gap up day established. So we can look at this intraday and see how it's been working. So Target gaps up. Normally I'm looking for about a 15-minute intraday pivot on this if I wanted to get into it. And then I've got the low of the gap up day, 1%, 1 to 2% below that to figure out what my worst case scenario is going to be. So you can see here at 9:55, it went above this first 15 minutes. You could use this as an entry, and it's held above it the entire time. Worst case scenario, this shouldn't fall below the low of today's gap up. And then you got to calculate what your stop's going to be and then position size accordingly for your risk tolerance. But for now, Target is a gap up, an extreme gap up that's working fine and is holding up So we've got the market in its favor because the market's acting fine. Group relative strength is an A, so you've got that in your favor. And very clearly, Wall Street, despite the fact that this was, and here's another example target. Let's just take a look back to the prior earnings report. They had the gap up. They had a day 2 higher high. The market corrected some in here. All it did was pull back to the 21-day exponential moving average. So if you bought this all the way back here, you could have been holding this into earnings and taken advantage of the gains. If you bought it later in here, you probably wouldn't have had enough gains to hold it through earnings, and that's a situation that we faced in-house here. So, but you've got rules. We got to follow our rules, and the rules are time tested and designed to put the odds in your favor, and we've always got our stop. So that's target for today. Let's move forward. ServiceNow, gap up here. This is a mild gap up 2 days ago. I believe that this stock got an upgrade. If you look back here to February, this was a extreme gap up on big volume, and it continued to follow through to the upside. Here's another gap. But now this was about the time back here that software stocks started getting weak. First initially here, and then initially here. So you're going to use, the worst case scenario would be a break below the 50-day moving average on heavy volume as your exit point. But now this is trying to make a case. Actually, yesterday, it announced that it's being added to the S&P 500. That's the reason for the gap up. But look at the relative strength recently. This is another thing to consider along with the market and support and resistance is what's the stock doing on a relative strength basis. So here we got a mild gap up and a second day above it. If you took an entry point, your stop would be, you have multiple situations for a stop. For one, you've got the top, and now we talk about gap fills. You've got the top of the prior candle here as a gap fill. The high there is 268. You're buying at 281. So you calculate your worst case scenario if it would come down and fill the gap, which is probably about 1 to 2% below the low of the gap up day. So actually, it's a couple more percent than that, but again, you use your stop to calculate what your position size is going to be. I already discussed Vertex, AAXN. This is another mild gap, pretty big. Here was earnings back here. I'm not sure what the reason for this gap up was. Maybe it was an upgrade or something like that. But big volume, range expansion on the candle, pulls back on lower volume, and right now it's testing the top of the high of the gap up day, and you're in a base, so you've got resistance above there, your support down here with the moving averages coming up through the 200 day, that's the black line, and also support at the bottom of the gap up day. Applied Materials, another one that just gapped a couple days ago. Now this is one that has pulled below the low of the gap up day, but within the 1 to 2%, and the ADMA is right there. So this is actually a lower risk entry than if you were buying it on the gap up day. Semiconductors are an A+ rated group. The market's going higher. You don't want to give too much below it. If it was a gap fill, you calculate what your bottom line is to this 5720 area should it fill, buying at 60, and get your position size correct and follow the rules. JD, this is a Chinese stock that had, this was a range expansion. Actually, what this did is gap up and fail. So let's take a look at a 15-minute chart on this. So this was 5 days ago. You can see how this gapped up intraday. And this is an example of an extreme gap up failing right out of the box. So here's your first candle. Your next candle is trying to establish a low, but it never gets back above that gap up day. So that would have been a hands off as far as buying, and it just continued to trickle lower all the way through the day. That's why it shows a gap on the 15-minute chart, but when you get back to the daily chart, it gave it all up, filled the gap, and has continued lower. So this is something you probably would have been stopped out of. On the other hand, if it gets back above the 21-day exponential moving average, you've now got support back here. We talked about filling a gap, so you had a gap here. Here's the high of that gap. That gap looks to be filled. The low is 3180. The high around here is 3183. Excuse me, so it did fill the gap. So there's very often both bullish and bearish things that you can see within a chart itself. If you bought the gap up, you should have been stopped out. If you haven't entered it yet and this rights itself, and suppose maybe there's a trade agreement and China stocks start acting better, you could get a low risk entry point, and your stop would be below the low of today's low, which coincides with the high of this prior consolidation. Coupa Software, they've got earnings in 12 days. This one is what I wanted to show back here. This stock had a decent run. It had this earnings report. It had a shakeout day. You can see the low of it, and the round number 100 capped it. If you've read Jesse Livermore's book, you know he talks about this, and you see it from a psychological basis that round numbers like this very often act as resistance, and you got to hit it a couple times before you get through it. So moving on to here, this is a situation where the stock had a very bad reaction on the gap down day, but it came right down to the 100 level here, which coincided with the 50-day moving average. So you've got two levels of support. You've got the 100 level, which was previously broken. You've got a little bit of a consolidation here that acts as support. You've got a move down day on earnings that came into that support, and look how the stock took off after that, moving from $100.52 all the way up to $148 in about 4 weeks. This is when software stocks were making their last gasp before they started to roll over in this area right in here. So there's another situation of, so we would call this a mild move down, or actually we would call it a range expansion day, because the low and the high were within this base. So this is the inflection point that we're looking for. Then the next day up on 400% volume, and it takes off to the upside. So this would fall into the range expansion category. Tesla, something else we own in the Growth Protection portfolio on their last earnings report. I showed prior to the 2013 initial move, Tesla has consolidated for years, unable to get above its recent highs. But here you can see the gap up day, big volume, 300% volume up 17%, and then the next day a day two higher follow through. If you didn't get it there, the pullback to the ADMA is a good spot for a low risk entry point, with the low below 1 to 2% below the low of the gap up day. Looking over here, you've got 352 as a prior high. The stock paused in the 352 area here before jumping out above that up to 360 yesterday, now pulling back 1.5% on lower volume today. This looks great, continuing to ride the ADMA higher. FTNT is another one. This is a mild gap up because it's still within the base. Day two higher high, a little bit of a consolidation, never gave up any of it. Stock's in an uptrend. Group is a D, but look at the relative strength starting to come back in the group, and a couple of cousin stocks acting well. Here's another situation where its last earnings report, let's step back. This is one where it gapped up and crapped. So this would have been a mild gap up, still within it, closed at the low of the day. The next day, a low below, you would have gotten out, and the stock did basically nothing since then, as software stocks were included, security stocks were included in the software stocks that were acting poorly. That changed with this gap up day. You can see what it's done since then. Franco-Nevada, here's a gold stock that had this gap up to the top of the range. So where's resistance and support? Here's the 100 area here. We faced it here, couldn't get back above it. The gap up went to the 100 area. The low of the gap down day, 96.94. Today's low, 97.66. So we're still above the low of that gap up day, and coming into the 21-day exponential moving average. This would be a nice low risk entry if it could get through 100, as gold stocks have been acting slightly better lately after doing some corrective action. Walmart, this is a situation where it had an extreme gap up that failed. I looked at a similar situation to this a while ago. Here's the gap up, but Walmart was sold off, never made a higher high during this first 15 to 30 minutes. It just sold off all day long, coming down back into the base. And now it's holding the 50-day moving average. So again, a mixed bag here. Gap up bullish. The reaction, bearish after the gap, breaks below the low, comes all the way back down into the prior base, and just wasn't ready. Skyworks. Here is, this was a news gap up, and this one is one where it's a range expansion. You see the low, it closed near the high of the day, that was bullish. It's pulling back to the 21. The 21 is still higher than the low of the gap up day. So you've got double support there, making a low risk entry if you think this is going to go higher. But again, you've got the 100-day round area that provided resistance as it tried to move higher here. Again, a mixed bag here. But all we're doing is looking for low risk entries to put the odds in our favor. Buying and selling stocks is a math problem. All you got to do is hit on half of them. You can win on 50%, and as long as your average win is twice what your average loss is, you can make a lot of money in the market. DocuSign, this is a gap up within a base, so consider this a mild gap up. Day 2 higher high, that's bullish. Market coming out of this correction, so you got that in your favor, comes into resistance, this 59.62 area, and blows right through it. So 4 straight up days, now it's pulling back. You would expect the prior resistance at 60 to turn into support, and it did here, and it did here. A little bit of price progress higher. I got stopped out on this. I bought it late. I bought it back here. If I'd bought it back here in the 50s, I probably would have had a big enough cushion, but my 8% gain was back down to 0. I got stopped out this day, and it's really just gone sideways, riding the 21-day average higher since then, earnings in 3 weeks. Xilinx. This is an example of a couple of concepts here. I bought this on this gap up day back here in January. This is textbook for what you want, gapping out of the base, so it's an extreme gap up, 18% on 500% above average volume, day 2 higher high, get in. Pulled back to the 8, continued to ride the 8 up, came down, held the 21. Now you got the next earnings report. I talked about this in one of the prior Lunch and Learn videos. So I've got a nice gain, I'm going into earnings, but I want to limit my downside in case the worst case scenario would happen with this. So talking to Tim, he tells me what the expected move is for Xilinx. It was 10%. I multiply that by 2 to get a worst case scenario to be sized appropriately so that I don't lose more than 1% overall on an earnings reaction to the portfolio. So what you can see is it gapped down 17%. I cut my position from 9% to about 5.5 going into earnings. This gap down, I reached my 1% threshold the next day when it broke below the low of that gap down day and exited it. And you can see it never got back above the high of that day, just trickled sideways for a little bit before it rolled over as the market, and here's another key, the market's starting to correct. So not a surprise that it's not making any progress to the upside. Comes down here, bounces off the 200-day moving average. Next earnings report, seemingly acting very well. That earnings report, would have been either a mild gap up or a range expansion day, closed at the high, but that put in the high. Look how it started selling off the next couple of days, comes down to the 50, pauses, breaks again, comes down to the 200, breaks below. Now the 200 turns from support into resistance, tries to get back above it, can't, tries to get back above it, can't, and it's just rolled over since then as the 50-day moving average continues to act as resistance on any attempt at Xilinx to rally. I had very high expectations for this stock. They're well positioned for 5G, but if the market doesn't agree with your thesis, you best get out of the way. EPAM, here's another one. This is a mild gap up, and it's continued higher. Again, market in your favor. Decent group with a B+, never broke below the low of the mild gap up day. Day 3 made a higher high, comes into the resistance here at the 200 area. So it's got double resistance, the prior top of the base and the round number resistance, but it broke through it here on 11.14, now pulling back on lighter volume. Looks great. Pinterest, here's two different examples here. So the first one here is a big gap up, and I own this. Give it 2% below the low of the gap up day, no big deal. But notice what the market's doing, the black line in here. Market really starting to act squirrely. No surprise that it doesn't make any progress. Tried to poke above the high here, failed, came down, poked below the low, never violated the 2%, tried to poke back above the high again, market still struggling, and it just rolled over. Broke below the 21, broke below the 50, formed a bear flag here as it tried to rally back up. But notice how the 50-day moving average is acting as resistance the whole way up, and then it rolls over again, and then the 21-day becomes resistance on every rally. Coming into its latest earnings report, this is a gap down, an extreme gap down, clears the low, makes all new lows, but it's a situation where so far the gap down has put in the low. So if for some reason your wife is addicted to Pinterest the way mine is, and you think you want to take a shot at the stock, you've got this 1871 stock below it. We don't invest this way. We don't buy things that are trending below their moving averages like this. But the point I'm trying to make is the gap rules say if you never break below the bottom of the low, regardless of the type of gap, you may have a change in character in the stock and see if this can put in a bottom and start going higher. Chipotle, here's one where the last earnings report here had a gap down, mild gap down, came into this 780 type area for support. So, and the low of the gap was 782 right below that. So, but it only took a couple of days, even though the market's acting fine. Reminder, Chipotle has had a pretty nice run here, breaks below the gap day, and even if you gave it 1 to 2%, and it came down here to the 200-day moving average. In this situation, we bought this here off the 200-day moving average because it's major support, putting in a bottom, relative strength turned, and we're looking to see now it's gotten back above the 21-day exponential moving average. We're looking to see what happens when it comes into this 800 area and the 50-day moving average. We may wrap up and take our profits. If it busts through it, we're sitting in a position where we've got a profit on this stock now. So we've got a small position in it. eBay, gap down here. 35 area, look over to the left here, you've got 35 showing a couple times, broke through the resistance here, came down, acted as support, 35 area, not really, it's holding, but there's just so many better stocks in the strong market like this, can't make any progress higher than the high of it, and this 35 area is acting as support for now. So if you're an eBay lunatic and you want to take a shot at it because you like the story, that's totally up to you. There are better in the market though. Netflix, this is a situation, a classic situation of support turning into resistance on a gap down. So Netflix had been acting very well here when the Q4 correction finished. It ran up from 231 all the way up to 358. Anytime it came back near the 200-day moving average here, it found support, 342, 349. So the 200-day moving average is acting as support as this stock works sideways until it gapped below it on the gap down day. You broke below the low of the gap down day, that would have been a sell signal. It stops at this 305 area, tries to rally back up, comes into this brick wall of resistance at the 200-day moving average, and rolls back over again. So if you thought you were getting something down here because you maybe had some support on the left side of the chart or the 300 Livermore type round number, but you ran into resistance here, it's just rolled over ever since then. Now in its last earnings report, had a mild gap up, and it closed at the low of the range for the day. Broke below the 50, broke below the 21, found support over here on the left area, but it's trying to right itself here. You can see now it's gotten back above this 300 area, which acted as resistance here, acted as resistance when it gapped up. The market's acting well, so it may take it higher with it. Bounced off the 50-day moving average here. You've got the declining 200-day as resistance. PayPal, another situation where we own this and the gap down got me out of it. First couple days it held the gap down, it held the 50, it held the 50 the next day, it broke below the low of the gap down day, and I believe we got out right around here, came all the way down to the 200, starts to rally up. Now you've got resistance with the declining 50-day moving average, fails there, comes down, you got the 100 area that it's acting as support, broke below that coming into its earnings, announced earnings and gapped up. But now you've got the 200-day acting as resistance, and it played around there, moved below it. The round number acted as support here, comes into the 200 again, acting as resistance, and it can't seem to get back above the 200-day moving average. So it's trapped between this 106.73 area on the 200 and the round number 100 support. Boot, this is an example of the intraday algos trying to take them out with an inflection point. But let's go back to the prior one. The prior earnings report, it had a big gap up and closed at the very low of the day. What was the market doing though? Market just starting to go into a correction. Definitely factored into it, in my opinion. You've got an extreme gap up that failed miserably. It came all the way back down into the base, then broke below and made lower lows. But that used that to form a cup, and then here with the last earnings report with the range expansion, algos taking out buy stops on the upside and sell stops to the downside, never broke below it. Market rights itself, and it starts to trend higher since then. This 39.59 area broke above it here, coming back into it. This should act as support along with the 21-day exponential moving average. Notice the volume lighter after this nice move up here off the 40 level 3 days ago. 2 days ago actually, giving back some of it, but on lighter and below average volume. Fleet Core, here was a big gap up here. Market kind of sketchy though. Just working sideways, can't get above this 300 level, again, round number resistance. And now you had a situation where its last earnings report, it had the range expansion, came down, hasn't broken below the low of that day, trending along this 50 and 21-day moving average, trying to get back above and out of this base. Payment stocks, I think that this falls into that category. They provide some of the backbone for processing, but right now you're in a base. Let's see what happens, and you've also got the 300 area here. Datadog, big gap up, IPO base. So you've got a couple of resistance areas here. The left side of the base where it formed the cup. You've got big volume. So this is a mild gap up, didn't clear it, but you broke below the low of the gap up day here. And this is probably algorithms triggering stops. If you used the standard IBD pivot point, you should have been stopped out here for your 7 or 8% loss. If you ignored that and you were position sizing based on the low of the gap up day, that's fine. You may still be into it as it broke below just briefly but closed back above the 80 MA. So this would actually be a lower risk entry than taking it here, and then you've got your low of yesterday as a stop out point. OLED, gap up here on earnings, trending sideways along this round number 200 day, trying to complete the right side of the base, tried to move out a couple days ago, pulled back, just going sideways since then. And finally, Shoe, Steve Madden, gap up here, decent group, B+ rated, bull market, gaps up and clears it, so it's a monster gap up, stays near the high. This is very bullish. The next couple of days, trends higher, pulls back, holds the 80 MA, hit the pivot point plus 20%. Sometimes you'll see it's one of William O'Neill's rules to take partial profits at 20 to 25%. But look how the volume's lighter. So some selling the last couple of days, but volume being lighter, still above its 21, and that looks good. So 10 minutes till. We've talked through 5 different types and the 15 possible outcomes that you can have from all of them, the things to take into consideration, the market moving averages, support, resistance. Let's, before we take Before I go back and look at charts of in-house holdings, let's take your questions. We'll do Q&A and charts on request now, so if you have anything you want to type in to the, all right, we've got lots of questions here, so let's take a look at them. Do you have a minimum percentage change from the extreme gap up down? How do you differentiate between mild and extreme gaps? Mild gaps mean it did not clear resistance on the left side, so it's still in the base. Extreme gaps are outside. It's a gap out of the base. So that's the difference between mild and extreme. Do I have a minimum percentage change to the extreme gap up or down? No. It's hard to buy something that has gapped up 20%, but history has proven that these can become big leaders, as I showed with the Facebook and Tesla 2013 examples. Do you ever acquire a stock position on the gap up, gap down? From your review, it seems like you see how the stock acts after the gap day and then look for an entry. Yeah, we do that. I talked about that with a couple of the examples. Sometime if it's something that's on our watch list because it's got the N in can slim, meaning it's a compelling story, they've got something new, and it's a bull market, and something pulls back on a mild gap down into support. We bought CMG a couple of earnings reports ago using that rule. If a stock gaps up and loses the gap shortly after intraday, do you look for the short entry after seeing how the stock acts over the next few days? We have so many retirement accounts that we don't normally short stocks in-house, and when we take counter positions, we usually do it with index ETFs. So we would look at not necessarily as a short entry, but as a way to take it off of our long list. Do you have any tools, tricks that help you smooth out charts for companies listed on multiple exchanges where every day, like a gap, such as a DEO, you can evaluate the true gaps? Okay, DEO, I'm guessing this is an ADR that trades foreign. And then you just have to accept the fact that these are going to gap because of what it did on the foreign exchange. And you really would have to look for an example like this, where it reported earnings, had the gap down with the bigger volume. So this is an inflection point. You got to decide what's going to happen after this gap down. And it put in the low for a little while, but it came up into the overhead resistance and 171 declining 50-day moving average and rolled over since then. Broke below the low of the gap up day. There's better stocks than this. Relative strength of 40, I wouldn't own it. Trending below the 50-day moving average and below the 200-day moving average. So if for some reason you're tied to this stock, maybe you work for the company or something like that, that's fine to look at some of the rules, but it's not a leading stock, so it's not something I would even be paying attention to. But the point is taken. When there are things that trade on ADRs, another one is Tencent, TECHY. This is a Chinese stock that trades as an ADR, and it really has these intraday gaps depending on what it did the night before in China. Same situation. Dexcom bought at 200.75. Yep, Dexcom had a gap recently, so good entry here. This is a comment from somebody. Here's a great example of a monster gap up out of the base, bull market, decent group, nice numbers here, 261 EPS, 49% sales growth. First day up, ran into this round number 200 resistance, consolidated the next day, broke above it. This is beautiful. Broke above it. This, if you bought at 200.75, I'm guessing that this was the day, or the then pullback into what was resistance now becomes support. Very viable there too, and now it's hit plus 25% from the pivot within 3 weeks. When you see this flag on MarketSmith, it means it's a sign of exceptional strength. It means it's 20% or more from the pivot within 3 weeks of breaking out, and this looks great. A perfect example of the point I'm trying to make. Low gap today. Let's take a look at that. LOW. This is a situation where it's between a mild and an extreme. You've got on the left side of the chart here the high of 118. It gapped above it. Let's see what it's doing intraday. Let's go to a 5-minute chart. So it gapped up, never broke above this 15-minute high. and now it's broken below the low of the gap up day. So not good action after the initial gap. Doesn't mean it's not buyable. It may just come down and fill this gap here above the high of a couple days ago, which is 116.80. You've also got 116 here, and it just may not be ready. You've also got the overhang that HD reported miserable earnings yesterday. It's the sister company. They normally act in sync, but clearly not in this case. Lowe's got something going on that Home Depot doesn't. With their 36% earnings growth. So make it a good entry here. It's only 6% above the 50-day moving average. I would watch to see what it does in the subsequent days. VRSN, asked to look at VRSN. VeriSign. Okay, again, D- group, but the security stock has been the security group. Let's look at Hack. This is the ETF, and I'm going to show you why there's divergence here between VeriSign and Hack. Look at the relative strength on Hack and the way it's been acting, coming up to the right side of a nice cut base, which is, by the way, is stage 1 because it undercut its prior consolidation. Now look at VeriSign. Not a leader. Certainly not acting from a relative strength standpoint the way the overall group and the leaders in the group are. Here's your gap up. It would have been a mild gap up because it's still within the range of the consolidation. Never made a higher high, broke below the low, has support at the lower lows over here. There's plenty of stocks acting better than VeriSign, not only in the market but also within the software security group. Let's see what it does here if you own it at this 200-day resistance here at a minimum. You want to see it get above there, then see the shorter term 21 and 50-day moving averages curl up and come up above it. But then look at how 200 acted as resistance over here, support over here before finally breaking below 200. So 200 is, I would expect, to be resistance also. Amazon seems to be stuck between 1,700 and 1,800. Let's take a look at Amazon, and we're going to wrap up in a couple of minutes here. Absolutely stuck between 1,700 and 1,800. Two things to take away here, Amazon. Let's take a look at a 60-minute chart here. The recent gap down did put in a low for now. You can see that this coincided with support on the left side of the chart. So the good thing is that it put in a low for now. But then the stock tried to rally while the market's rallying, got right into the 200-day moving average, and the 200-day moving average continues to act like a brick wall for this stock on this most recent attempt up after earnings. So this is not a leader right now. There are plenty of big NASDAQ stocks working better. Look at Apple, look at Microsoft, look at Google. Amazon's a laggard right now. It was a negative reaction to earnings. You had the gap down. It was supported by support on the left side of the chart here. So if you own it, that's great. If you've owned it long term, that's fine here. You do not want to see it break below the 1685 area, or you could be in for some pain. Look at the next area of support over here. You've got 1672, and then you've got a bunch of support in the 1500s. But right now, Amazon trending below its 50 and 200-day moving averages. And something must have just hit the market as we're getting a big move down here in the indexes as we get. And you can also see that I'm getting some downside alerts. Let's take a look at a 5-minute chart of the indexes. I don't know if there's some news that just came out right now, but maybe something trade related. I don't know, but this is not what you're looking for in the market, and maybe this is the beginning of the pullback that we've been talking about. So let's see if SPY can come back here into the 21-day exponential moving average, which is only 1% below this. You can very easily hit this today and see what happens. So intraday moves. This is an example of what happens. I mean, this is, depending on how this plays out, this may be just a blip, or it may be an algo range expansion within the base, and see what happens in the subsequent days. So let's take everything that we've learned and apply it to what's going on in real time right now. Right now, I know it's a 5-minute chart and we don't normally trade off of these, but You've got a low here of 309.56. I'm going to set an alert at 309.56 and see if we break below it. Now let's take a look. We've got a gap fill over here. The high of this gap was 309.64, so we just touched that, filled this gap. How about that? See if that filling of that gap is all the market needed to do and we end up going higher, or the next area of support in here is going to be 308 and 307. You can see 308 was the bottom of this consolidation here. 307 acted as support on these pullback days. So never a dull moment in the market, so isn't that nice? Let's see. And I'm getting somebody typing in, CNBC reporting that the Trade One deal with China may not happen this year. So that doesn't surprise me. We talked about this, Tim and Danny and I talked about this on our call this morning, that the legislation that the Senate passed yesterday basically supporting Hong Kong is definitely a slap in the face to China if you're trying to get a deal with them. And let's see how it plays out. We're due for a pullback. Maybe this will be the catalyst that gives us this pullback. So you just monitor going forward. As always, set your stops. What's going on in the indexes will trickle down to sectors, and it'll trickle down to individual stocks. So this is why we set our stops. All right, so it's 1:01. I'm going to wrap this up. Yeah, obey your sell rules when you've got a pullback, but as long as we're trending above this 21-day exponential moving average, which is again less than 1% away on the S&P 500. Let's take a look at it on the QQQ. We are 1.1% above it. You've also got this round 200 area on the NASDAQ 100. Let's check the Dow. Dow 28,000 was acting as support. Okay, let's go to the DIA, which updates in real time. 0.7% above the 21-day exponential moving average. IWM 0.6% above the 21-day exponential moving average. It also coincides with this low from 5 or 6 days ago. So those are key areas. I'm going to wrap this up. Thanks for participating. We didn't get to go through the charts of in-house holdings, but so much education in here. I hope you really enjoyed it. I enjoyed doing the class. Thank you very much, everybody. Have a great day.